I hope you're doing well. In today's video, I would like to answer a few questions that I have been asked during the last few weeks, the answers to which I feel might be useful and relevant to you in your own trading and investing career and as a student of the market. So, the first question that I would like to address is, when does one know that one can quit one's job and start trading as a full-time career? The next question is, how does one build a long-term portfolio that is good for them? And what direction should they take? And what things should they keep in mind while building such a portfolio? Finally, a trading question. What are my views on SL hunting during derivative trading? So the first two questions, we can take it up together because in order to start your journey as a professional trader, in addition to having necessary technical and other skill sets, you also need to have a sound financial background or financial stability. In other words, the point that I'm trying to make is that as a professional trader, the health of your P&L curve, profit and loss curve, is directly correlated to the health of your balance sheet. If your personal balance sheet is in trouble, that is, you are having liabilities uh, or more liability sources than income sources, then the probability of you becoming a trader, despite having satisfactory technical know-how, a successful trader, despite having satisfactory technical know-how, is very, very low. And which in my earlier videos, I have said it is as low as 1 in 100,000. So therefore, when one has to start one's journey as a professional trader, there are several aspects to it: psychological, family support, social conditioning, attitude towards money, but also having a strong financial background or a secure financial background is paramount. So, in attempting to answer the second question, I believe I would have partly answered the first question, and also that the answer to such a question uh, is very individual specific, and therefore it becomes difficult to lay out a generic theme or a template that is applicable to every student of the market globally, regardless of their age, financial standing, etc. So let's begin with what I have prepared. So to answer these first two questions, we'll first move on to a slide. And the title of the slide is Financial Planning or the Optimal Investment Plan for Investors Less than 35 years of age. In this segment, I have typically included those individuals who are employed, which means that they are their core source of income. And individuals could have different levels of income, but the source of income is the individual themselves, which means that there could be an individual who is earning and saving as less as 100,000 rupees a year, whereas there could be someone who could be 100 times more that value. But regardless, both of them at this current stage have a single source of income. And to make a financial plan or to make a financial advice, there are certain prerequisites that we will meet for the presentation to be relevant to you. The first one is, to make an investment, particularly in the securities market, one needs to have savings. So it is important to understand that in order to have savings, it automatically implies that you have income, and that income is greater than your standard expenses. The next point, of course, is that you should never trade on borrowed money, which is obvious, which means that even if your income is greater than your expense, you should not leverage your personal balance sheet for the purpose of trading. The markets within them the markets within themselves have a structure of providing you leverage. You could leverage the capital that you have saved, but to leverage your own personal balance sheet for the purpose of trading is extremely risky. And finally, adequate health insurance is not only far more important than term insurance but also mandatory. Remember, no financial planning or no planning is possible if you are not covering the worst case scenario. For an individual who is their only source of income, for such an individual, a prolonged chronic illness is perhaps worse than the finality of death. It is very, very critical and paramount that your health insurance covers chronic illnesses. And I personally believe that health insurance is vastly more important than term insurance. Term insurance can only provide liquidity to some extent, and term insurance should be taken by those people who are heavily under liabilities. So, for example, if I am a practicing doctor and if I am working in a hospital on a particular salary, then such a person I would never advise to take term insurance because such a person has no other ongoing financial liability, assuming. But consider the same case if I am a doctor who is working in a hospital but has aspirations of creating his own hospital and for such a purpose requires land, construction, infrastructure cost, manpower costs, and so on. To arrange for this setup as a doctor, it is possible that I might have mortgaged or leveraged my family holdings such as land, house, etc. to generate the capital. I might have collateral them. It is very critical for such a person who is under so many liabilities to take on term insurance because in the event something is to happen during before the fruition of the project, you might end up losing your family assets, and therefore the value of your term insurance has to be equal to the value of your ongoing open market liability and maybe something more just to provide liquidity. But term insurance without any direct liability is a redundant step in financial planning, and to not have health insurance is a cardinal sin. So, with this prerequisite done, let us begin with the investment steps that I believe can be followed by almost everyone. So, the first step is to determine the maximum risk free interest rate in the country. Now, it depends on which country you are in. In the context of the presentation, we will assume that the country here is India. And we know that the maximum risk free interest rate in India is approximately 7.5%. And this is provided by the Public Provident Fund or the Sukanya Samriddhi scheme. So, the key point being that the maximum risk free interest rate is basically our benchmark value. That is, this 7.5% is our benchmark value because this value is not only representative of the growth but is also representative of the underlying inflation, currency devaluation, interest rate fluctuation, and various other macroeconomic parameters that are built in into calculations of an interest rate. Given that this interest rate is significantly higher than the ongoing government bonds, this interest rate becomes our benchmark for growth. That is, as long as we are meeting this particular value on all of our capital investments, it is reasonable to assume that we would have outperformed inflation. Because during periods of high inflation, this risk free interest rate will also become higher. Next step is to determine the capital limit that the particular instrument offers. So we have understood that 7.5% return becomes our benchmark because that is the maximum risk-free interest rate that is currently offered. Therefore, if we are taking risk, it is only justified if we in theory can gain greater than 7.5%. Now, we further understand that in order to get this 7.5% risk free interest rate, the maximum that an individual is allowed per annum is rupees 150,000. So which means that rupees 150,000 is the, as a capital, needs to be allocated to the maximum risk free interest rate in the country under the justification that there is no question of default and that this growth rate is higher than all other prevalent macroeconomic headwinds. So once we have understood that for an individual rupees 1.5 lakh or 150,000 is the maximum per annum, which could be different in different countries, but for the context of India, this is the maximum that we can currently do. Therefore, our objective is to maximize our capital allocation in the PPF and Sukanya Samriddhi, because we know that this is definitely positive. And for a household level, that is typically husband, wife, and two children, or husband, wife, and grandparents. So at a household level, this on an average would amount to roughly rupees 6 lakhs or 600,000 per annum. Now, in other words, if you are the sole income, a source of income for your entire family, and your family has a total of 4 members who are dependent on you either now or in the future, then the rupees 6 lakhs allocation to an instrument which has the highest uh, interest rate, risk free, automatically implies a monthly expense of 50,000 per month, 50,000 rupees per month. And this in itself, to be able to generate savings greater than 50,000 rupee per month per household, is automatically greater than more, perhaps 97% of households in the country. In other words, for the purpose of your ultra long term investment, the Public Provident Fund and the Sukanya Samriddhi scheme should meet the requirements of almost 98% of this country to its full. And the question of hedging and protecting this investment only comes into play provided you are saving an amount greater than this particular value at a household level. So now let us assume that you are saving an amount greater than rupees 600,000 and give it some value, let's say 2 times this value, and say you are saving, your household is saving rupees 1.2 million per year. Now we understand that long term debt instruments are subject to currency shocks. So what it basically means is that, for example, the the USD INR exchange today is approximately 80, which means for every 80 rupees in our account, we have the purchasing capacity of $1. If for any reason there is a depreciation in the currency, let's say 25%, and the value now is 100 USD INR is 100 rupees to a dollar. Now, and your account, let us assume, has a total of 400 rupees. So when the dollar was at 80, your account had 5 US dollars. But when the dollar becomes at 100, your account now has only 4 US dollars, which means that there has been a depreciation in your principal value, and this in absolute dollar terms, and this depreciation has happened because of depreciation of currency. So in other words, when we are investing in ultra long term debt instruments, our biggest fear is any currency shock on the downside. So for example, if the Indian rupee were to become like the Turkish lira, the Pakistani rupee, the Argentinian peso, obviously Zimbabwe dollar, and many African, South American currencies, CIS currencies like that in Uzbekistan, Tajikistan, etc. So if any such event were to happen during the course of our investment, then even though we would not lose the principal, but our principal would lose value. And therefore this Loss of currency value is the number one risk that a long-term debt, um, a risk-free debt investment has. And therefore, to hedge against this risk, then I recommend the next instrument, that is the sovereign gold bond, which means that if your household savings are greater than rupees 600,000, then you should begin to invest in the sovereign gold bond. Now, what the sovereign gold bond will do is it will give you 2.5% risk free interest rate. The fact that it is sovereign means that default cannot happen, and your principal is pegged to the value of gold, which means that let's assume a sovereign gold bond has a maturity of 8 years. Let's assume gold is currently priced at rupees 5,000 per gram, and the minimum investment is on per gram, which means you have to invest in rupees 5,000 and multiples thereof. So let's assume you buy 1 gram of gold, you save rupees 6 lakhs 5,000, and your 6 lakhs from the household level has gone into the PPF and the Sukanya Samriddhi scheme of various family members, and this additional 5,000 rupees now you allocate to 1 gram of gold. Now so what will happen? So over the course of 8 years, this bond, over the course of its maturity of 8 years, is going to generate 2.5% per year, which is in total going to be 20%, which means that your principal investment of 5,000 8 years later is a principal investment of rupees 4,000. The current price of gold is rupees 5,000 a gram. The question is, what will be the price of gold 8 years later? If the price of gold dips below 4,000, it is at that time you risk or begin to start losing your principal. However, if the value of gold is significantly greater than 5,000 or greater than 5,000, you have capital appreciation. Now, we are talking about long term investments, and PPF could be 15 years, 20 years, 25 years. Similarly, multiple tranches of gold bonds in the 8 years duration. We know that if a country's currency loses value, then the value of gold appreciates in that particular currency. And therefore, to compensate for any currency risk to our initial investment of PPF SKS, we allocate maximum of the same amount into gold. In this way, at this point, if we are saving approximately rupees 1.2 million at a household level per year, your household would have, of course, insurances, but it would have a 1:1 debt, commodity related linked debt, bullion linked debt exposure, and both of them would be sovereign. Both of them would be uh, extremely safe in terms of principal. One of them is going to definitely outperform inflation, while the other has the potential of speculative gain in the event the macroeconomics do not work in our favor of the currency. Particularly then, there are of course other reasons for a potential appreciation in gold, but for all practical purposes, I do not see the value of gold dipping below 3,000 rupees or 2,800 rupees, which is its 2013 high, um, under any circumstance. So therefore, buying gold at 5,000 with a stop loss of say 2,800, 2,500, you're covered up till 4,000, you are risking 1,500 rupees per unit, I feel is a very reasonable bet, and gold has the potential of generating 3 to 7% in that particular range over any 8-year period. So it will not be, in the worst case, that is, in the worst case, it's a great investment, but in the best case, it is not a very bad investment. So also you could monetize gold at a later date to meet significant capital expenses related to marriage or higher education of your children. It is just as useful. So I'll move to the next slide after this, the fifth point. Now we move to the sixth point. Now, given that the purpose of the sovereign gold bond is just to hedge the investments that we are making in PPF, it can never exceed 6 lakhs per annum at a household level. And if let's assume you are responsible only for yourself, then this value is 150,000 rupees per annum. Now, in the event the household is saving greater than rupees 12 lakh per annum. So now we have discussed 6 lakhs per annum in PPF and Sukanya Samriddhi. We are now discussing a maximum of rupees 6 lakhs per annum in sovereign gold bonds, and we have already understood that by targeting 6 lakhs per annum in at a household level, we have already met the investment requirements of over 98% of the country. And more importantly, the investment is safe. There are no unnecessary costs. Uh, it is immune from bankruptcy. uh, it is the safest of the safest investment. It is the only subsidy that is given to the middle class. And it I means, if suppose the government were to change the slab from 1.5 lakh to 2.5 lakh rupee in the future, guaranteed you should invest more. That is, you should go for 2.5 lakh, and all of these equations would change accordingly. And if the slab were to dip from 1.5 lakh to 1 lakh, then too all of these equations would change accordingly. So therefore, pegging your investments to the prevalent maximum capital allowed at a risk-free interest rate is very critical, because you are essentially, by pegging it to that value, you are essentially letting major economists determine the position sizing that you should take for your investment portfolio. So you will just assume that the PPF is designed as a subsidy and therefore will match currency devaluation to some extent, and inflation almost certainly. But in the event the families save more than 12 lakh per year or 1.2 million per year, it is then you can now begin to start creating an equity linked portfolio. Now, why am I saying it is then? What happens if you do this before even starting the PPF? Then this is the definition of an extremely risky investor. That your family has just about 600,000 or lesser in total savings, and you are allocating all of those savings into equity investments. That's a high risk investment, and you are taking a bet that the country's macroeconomics or the general market is so strong that a well diversified investment will outperform every other secure investment alternative that is there. It is a reasonable bet to make, which means that if we had to take a bet today in 2022-23, that 25 years from now or 30 years from now, by 2050, what is India more likely to look like? Is it more likely to look like a Japan, or is it more likely to look like a Sudan or a Yemen? I would take a bet that the first case is more likely. If the country is to move in that particular direction, there is no ambiguity that the equity market will appreciate by almost 100 times in that duration, and therefore investments in equity is paramount. The only question is when. By allocating full capital, which means that let's assume your household is saving 600,000 per annum, you could decide on a cluster. That is, you could go little bit on PPF and Sukanya Samriddhi, little bit on gold bond, and little bit on uh, equity direct mutual funds, which means you're going in a 1:1:1 ratio on a very low capital base. um, if you have the appetite for it, you can do it. But I still feel that we should look at each balance sheet at its own merit. You should look at your own balance sheet at your own merit. And I'm assuming that you're most likely either married and have kids, or are going to marry for the purpose of having kids. So the number one difference is going to be is that you will have to learn to distinguish your own personal balance sheet from that of your family's balance sheet, and you will have to take decisions in the best interest of each member of the family's balance sheet. That is, you cannot have everything going on in your balance sheet and vacant to nothing in the spouse or in the children's or in the parents' balance sheet. It is simply more effective. It diversifies and it prevents the family from any shock that could set you back. Um, so yes, so when you are at a household level saving a capital greater than 12 lakh, there is justification now for the family, it could be any individual in the family, to begin to start investing in the equity markets. And my preferred method of going into the equity market with a capital of just rupees up, means say approximately 6 lakhs per annum, is to go via mutual fund, which means that if you can go up to a maximum SIP of 50,000 per month, then I believe the capital is too less for you to consider participating directly in the stock market. And you should invest in the stock market via mutual funds and preferably via the national pension scheme. And within the national pension scheme, preferably via access banks as service providers, because this is perhaps the most cost efficient way of taking exposure to the long term equity markets as an investor. And you are likely to get excellent diversification and allocation and a mix of debt and equity, which will be great from a 30-year perspective. And further, if you have seen or have seen the market in the last 5 years, 3 years, then you would be very happy with the stability that such an instrument provides. So this would be my preferred choice. In other words, I am suggesting 6 lakhs rupees in PPF, 6 lakhs rupees maximum in sovereign gold bond, 6 lakhs rupees maximum per annum into mutual funds via NPS, and that in itself should allocate has accounted for roughly savings of 18 lakh rupees a year, which is roughly 1.5 lakh at a family level. And now let's assume if the family saves further, which means let's consider 6 lakhs rupees again as the one unit for the household level, and let's say the family has continued with more progress, financial progress, and the savings are roughly 2.5 million for a year, then I would suggest that the individual now open a demat account. I mean, if not earlier for the NPS, but now open a demat account for the purpose of directly buying into equities, which means that it is most likely that the mutual fund that you bought in the through the national pension scheme would have some exposure to TCS, to Reliance, to Bharti Airtel, to SBI, and stocks as such. Now it is your job to micromanage that demat account, and I means the mutual fund would have bought it to stay invested in it for as long as reasonably possible. In your case, you will now create your demat account to actively participate in the swings, the weekly, monthly, annual swings of the market, and try to make specific entries and exits in order to maximize your risk adjusted returns, which means that beyond a saving of roughly 1.5 lakh rupee per month at a household level, the household is now ready to start taking some risks in terms of principal investments. And if the surplus money is coming in the form of monthly installments through rental property or through salaried income, then a small exposure directly into the equity market and trading the large cap stocks will retains a possibility of high growth rate. But even if that does not happen, the individual who is working on the demat account is going to grow intellectually, academically, and learn various aspects of business and economics that could help him in other aspects of life. So after roughly investing 1.5 lakh per month into PPF, per month into the combined instruments of PPF, sovereign gold bond, national pension scheme, any other surplus income can definitely be added to equities. And combining these four instruments, that is, these four instruments, PPF, as sovereign gold bond, NPS, and equities, alongside the insurances, we have now made an investment plan for any family that is saving up to rupees 25 lakh per year. And we are officially now perhaps in the 99 percentile category in the country. That is that percentile which has what we would call accredited investors. That is, most likely they have inherited wealth, and the individuals of these households are now custodians of wealth that might have come from one, two, three, four, five generations, and so on. It is very, before I proceed, it is important for us to know that the one thing that almost 90% of Indians today, regardless of our age, 90% of Indians today will have in common is that we are born out of very poor ancestors. So if we look back three, four, five generations, we can easily identify a point in time in our family's history when we were extremely poor, or what the world would define as below poverty line, where there is living out of camps, living out of kacha houses, inadequate infrastructure and things like that. So the families have since then progressively moved up. Each one of us are in a different journey, or on a different point in that journey. Life is very comfortable till an individual is saving up to this much money, as most of the investment decisions are textbook, and you, unless there is an institutional level, country level, world level collapse, you are generally doing better than the rest of the world at this particular stage. The challenge starts happening is that once the family starts saving more than this 2.5 million per year, which means now the net savings are greater than 2 lakh per year. By net savings, I would mean that after all of your life's expenses are deducted, your insurance premiums, electric utility bills, living expenses of children's education, and so on and so forth. Once all of these are deducted, you still manage to save approximately 2.5 million in today's currency terms per year. Then the challenge for such a household is that the conventional methods of income cannot create growth any further, which means that, let's assume that you are working on a CTC of 10 lakhs, 20 lakhs, 30 lakhs. That CTC means if your total earning per month is 1.5 lakh, but your household is saving that much money, then chances are that you are working in a good firm, but your role is not consistent with your family's current position. And therefore, if you continue to work there, you will grow at a 10, 20, 30% CAGR at your work, assuming you do well and the organization does well. But the challenge is you're growing out of a very small base. A family that can save more than 2.5 million a year at a household level is a family that has multiple investments. And for such a family, I feel that there is a decision where an individual needs to take whether to continue with these standard investments that are outlined here. So these standard investments you have to outline because this has been taken care of. But if the family is now saving more than this money, maybe they're saving 10 million a year, then your conventional ways of income, that is your PPF, Sukanya Samriddhi, etc., simply cannot create wealth. And now at this stage, that is at this stage, when you're saving more than 25 lakh a year, it is now time for you to monetize your core skill. And that is where your focus needs to be. So monetization of your core skill is basically where your growth is going to come from. So you're saving more than your household is saving more, minimum of more than 25 lakh a year. That is the saving which has gone into investments as the standard. And now you feel you are a singer, and you always wanted to pursue it professionally, then you should go in that direction. If you feel you were an artist, maybe a writer, then you can afford to go in that direction. Because remember, by considering household level, you have created ultra long term positions for all members of your family, as the karta of the family. and therefore now financially speaking you are in a position to pursue whatever is your core skill, and in with the objective of monetizing it for further growth. And if your core skill is trading and you meet the above criteria, that is of this saving, only then can you increase your exposure to short term leverage instruments. So this I think would be sort of like the summary. By that what I mean is beyond a certain stage you cannot grow without taking any further risks. And the purpose of your training, that is all the hard skills, the soft skills, the attitude building exercises, the pre-market ritual, post-market ritual, documentations, and everything that you do, the research, all of the work that you do is only designed to direct you, is basically training you to build your core strength. Because only if you have a good core skill set will you be able to deploy excessive capital. I will just repeat that only if you have a high core skill set can you deploy high capital. In other words, capital does not chase growth, but rather capital follows conviction. So, if you have conviction, you are very likely to allocate a greater part of your capital. Now, by basically making this condition, that is your family should be investing approximately 25 lakh per year in these four instruments and adequate health insurance. If this criteria is met, then it is my view that of the many criteria that are required to determine when you can quit your job as a full and start a full-time trading career, you would have met the financial criteria required to start a job as a trader. Now, whether you're a good, if you meet these criteria, that is, if you meet these criteria that we have just discussed, then if you remember that at the start of the video, I said that a poor balance sheet, a trader with a poor personal balance sheet has a less than 1 in 100,000 probability of success. So, after meeting this criteria, you now have a 1 in 250 probability of success, where success is defined as being net profitable over a 5-year period. So 1 in 250, 0.4% is not a great number. Even then, having said that, it is far greater than coming in the 1 in 100,000 range. And by meeting this criteria, you would at least not put yourselves and your dependents in a situation of financial ruin. Now, why would I talk about this as a situation of financial ruin? Because this is the only threat that you actually have. It is very difficult for one to imagine that, let us say you started off with 10 lakh rupee trading capital today and you have been trading for 25 years, and that 25 years later the capital is still 10 lakh. It is very difficult for such a scenario to pan out. So, assuming your one time investment was 10 lakh, you never added capital further, and you continuously traded every day for the next 25 years, the probability that your capital will remain at 25 at the 10 lakh only is almost non existent. One of the two things are very likely going to pan out. I would say 99.6% the probability is you will not last 5 years. But in the event you do, then there is a 99.92% probability that you will not last 10 years. But in the event you do, then that 10 lakh is going to be a huge amount. And if it is going to be a huge amount, then what you basically need is not to have the ability to determine whether Infosys is going to move up or going to move down. That is not the skill set. The skill set that you need to develop is how much are you risking at any given point in time, and what is the maximum theoretical downside that you have if you run your process of decision making hundreds of thousands of times in any particular iteration. The only way you can determine that value, very often I find starting out traders asking me, how do I know how much can I lose? If I'm investing only 2 lakh rupee, then I cannot lose more than 2 lakh rupee, and so on. In fact, I'll just share a conversation I had with a friend of mine. He's my batchmate, very good academically. He called me up and told me about his investments in the Adani groups, how he felt that the company was poised to do well, how he invested rupees 1 lakh because he knew it was going to increase, etc. And now, a certain number of months later, his investment of 1 lakh is approximately 2 lakh 15,000 rupees. And he's calling me up and asking me, so how do you think I performed for a person who's not a full-time trader? Given that you are a full-time trader, so what do you think of my 100+% returns? Now my question to you is, what do you think I answered? I mean, here we have an individual who has just got 120% returns or 100% returns in less than a year, and his question is, what do you make of it? So my so obviously the answer that I gave him was that it is a horrible performance, and he was I don't think he was expecting that, and his perspective was, why, what makes you think it was horrible performance? And I said that if you knew that the Adani group was poised to rise, that given that I know that you are worth at least 10 crore rupees, why did you invest just 1 lakh into Adani group? If you knew it, that it is going to rise, then why did you just go all in? So either you did not know for sure, or that what you knew was only worth 1 lakh rupee according to you. So my point being that is that an individual could have the greatest trade of his life and still make an insignificant amount of money. The individual could feel very intelligent on that particular trade also, which is good. It's a good, encouraging feeling to have, and you would need that during the process. But you must ask the question, what percentage of your net worth did that trade change? And what percentage of your net worth did you begin this whole exercise with? If you have a house in Pune, Mumbai, Delhi, Chandigarh, Bangalore, Hyderabad, if it's a standard 2-3 BHK house, probability is that that house is well above rupees 10 million. Probability is that your parents already have an ongoing PPF or some long-term insurances, long-term investments, PPFs, gratuities, land, ancestral land, maybe commercial offices, etc. Some very few people have businesses and factories. Now, if such individuals are to invest $1,000 in the market and get 100% return on it, uh, what's the point then? Why invest just $1,000 when your capacity to invest was perhaps $100,000? So, uh, the point being that capital is a measure of your conviction, and highly skilled traders very rarely trade with very low capital. It is very rare that something like that will happen. In fact, highly skilled traders will use more capital as a premise to build more systems. And the reason for building more systems is because greater the capital, the less you want to lose in absolute amount terms. It's no longer about percentages. So just to share with you, a 10% drawdown is extremely painful. So having the theoretical 30-50% drawdowns, 80% drawdowns on your portfolio, it's very tough to see. I mean, usually people who see 20-30% drawdown in their portfolio do not go back and see the portfolio again. That's the usual. At 60-70%, not only do you have a bad portfolio, but by continuously seeing it, you tend to add more to that portfolio. So it is very critical to be very cognizant of how much you are risking and how much you're losing, and that can only come after you have covered certain bases. And that was my point of taking up how to build a long-term portfolio to answer the question when you can quit your job. If your family is saving more than 25 lakh a year, by all means you can quit your job tomorrow and start this process, because your job is not going to make your family wealthy anyways. Now whether you wish to start trading or whether you wish to start your own independent business like a restaurant, a taxi service, an online application. This is up to you. But beyond a certain stage, a pure salaried job only makes sense if you are a subject matter expert at the highest level. So, for example, if you were to create the vaccine for AIDS, then you would need 100 million. Assuming you were destined to create the vaccines for AIDS, then you would need $100 million setup for the testing, the trial, the clinical trial, pharmacovigilance studies, the documentation, and so on. Even if you're saving a lot of money, given that it is your personal internal calling to create that medicine and that you're a trained biochemist, you could take a decision that is not financially prudent for the purpose of higher calling. And in my opinion, that would be a very, very logical, rational decision. However, unless you are that extremely talented biochemist or an extremely talented musician or an extremely talented athlete, for the remaining 99.9 percentile mortals like you and I, it is better that you meet the financial requirements before taking the plunge of jumping into it full time. Because essentially, full time trading, when people are saying that, can I get into trading full time? I would say yes, provided you don't stop your current income sources. But what they are looking for is they are looking to stop the current salaried income source and are now dependent on trading to create an alternative to that income source. In my view, you are never ready for that. So at least your family should be financially prepared, because even then your success is not guaranteed, but the fall will be much smoother. And it's been a longish video. I'll just cover this last point here. It was an interesting question I got asked on a comment, that what are my views on SL hunting in derivative trading. So SL hunting, stop loss hunting, you will often hear a lot of trainers use terms like they're very smart, they're very fast, they have access to all the data, uh, they see real time market movements, they have access to all the news. The question that I have never got an answer to is, who is the they? Who's the they? Who has all of this information? We, no individual, we have already discussed this in the efficient market theory hypothesis, that no individual, institution, or a group of people can have more information than the market itself. So when information is not an edge, I would even argue that speed is not an edge. In my opinion, what the edge is just planning. But so the reason why, I mean, often, I mean, just to draw uh, a parallel in another industry, like say if you have ever gone to an astrologer, and the astrologer would say something like, okay, this person has a mool nakshatra, and this is, he's born on a mool, or she's born on a mool nakshatra, and that is very inauspicious for the father, so you should get a prayer done right away. Now, once you have received that information, you're presented with two choices. Either you make a claim that the astrologer was lying or he's incorrect, or you make a claim that you will never be able to figure out what the correct answer is and you take the safer alternative. But the third perspective is that the astrologer played on this thought of ours that we would never get the real answer, and positioned his offering via fear. Since many people like Vivek Bajaj, P.R. Sundar, and tons of Akshat Srivastav, and tons of other non trading mentors, since their product is education on a subject which is not being taught by any financial institution in the world, like IIMs or top MBA colleges, uh, no financial institution is teaching this subject, but they are teaching this subject, and the argument is to sell fear. Now, one of the many fear mongering pitches is called as SL hunting. And that SL hunting is to remove the confidence of a trader to keep a stop loss to begin with, because the trader begins to start believing that the stop loss will be taken out as it is. So what the trader does is he buys a stock at 100 with a clear plan to exit at 98, but doesn't put the hard stop loss there. Very often the disciplined trader exits at 98. Very often they take profits. But when you repeat this hundreds of times, thousands of times, is one fine day when the stock, instead of hitting 98, came straight to 92, and you feel like a mouse in front of a snake. You can't move, you're frozen. You wait for a day, and next day the stock is at 84. So essentially, by obsessively pangering about SL hunting to the extent that traders are not putting stop losses, uh, and if you're not putting stop losses, you will always need a mentor. Whereas if you're putting stop losses, your own trading documents will become your mentor. So in my view, there is no such thing. Simply put, there is no such thing as SL hunting. It doesn't exist. So, for example, if I just see the Nifty chart here, okay, we are looking on the daily time frame. We are looking at this current close, which you can see at the bottom part of the screen is talking about 20th September. That's the last trade session. And now the argument could be for SL hunting. So I'll tell you how it normally structures. It's very simple. So we have, so let's just come here. We are seeing the market continuously rise from this point here. I think, okay, I'll just mark it with something. So I'll just mark this. So we have this clear pivotal low in this region 15,100, and from 15,100, which the market created on 17th of June, we are now on 17th of August, for example, the time of this test, and within 2 months the market has moved from 15,000 to roughly 18,000. That's near 20% move in 2 months time, which in a CAGR terms would be just would be very high, almost 100% CAGR kind of a move. So the market has moved for 2 straight months to almost 3,000 points, and after another green day, the next day the market closes with a clear red. There is a minor gap as we can see, but the red is big in, but with compared to this candle and compared to this candle, we can see that it's a big gap and fully encloses it. And so obviously what we have here is now a clear-cut case of bearish engulfing. And we know that a bearish engulfing will need a confirmation, which we get here. So this is now the bearish engulfing confirmation, and with this we obviously know that the pivotal high is now resistance, and that is roughly 18,000 levels. And so we see what happens the next day. So after seeing a bearish engulfing and a lower top, we do not know where the market will stop, but we expect to see it going lower, and we see several pivotal supports. So if we go back somewhere around here, we can start seeing that there was a gap support right here. So we could feel that, all right, 17,000, 18,000 to 17,000 is a wide enough range. Maybe the market could be testing that. Of course, this gap support, the one that we are seeing here and the one that we are seeing here, has been violated. So this one becomes a next major support, so to speak. So anyways, the market gaps down and closes in between the closing of the previous day candle, and we have already studied this before. This becomes our bullish piercing. So this is a bullish piercing candle, and like any bullish piercing candle, we are looking for a confirmation, which means that we want a green close above the high, and the next day we don't get that. The next day again we don't get that. Again we don't get that, and we get a gap down instead. So after 3 days of consolidation, we get another gap down with this low. So this bullish piercing is not confirmed, and we will move this aside. So we'll just see if we can use it later. And we get a big gap down with a green close. So Nifty is approaching its support level, and let's see what happens next. And after this, we get a humongous gap up. So this bullish piercing, incidentally, was not a bullish piercing, but rather this was just a morning star, right? So because we have a red close, gap down, gap up, and this particular candle on the gap up that we are seeing, this is not necessarily a Marubozu, but this is something that we call as a insane candle, insane, INSCN candle, largely because it engulfs the trading of the entire region. It's a very large candle. It's a daily candle which is engulfing the price action of an entire week. So we have the morning star. We will obviously look for a confirmation, which we do not get. We again do not get. This process continues. But with the presence of this morning star and a couple of green closes, we can now safely move this one here. We have clear green closes, and we can safely now say that even this is a strong resistance. So we have got Nifty now trading between the 17,000, not the 17,000 as we had earlier thought, but 17,150 to 18,000 mark. So when we are looking for a clear confirmation of the morning star, but in either case, let's see how it goes. Another red close, no confirmation. It doesn't. That is, a confirmation is a green close above this high. Again, you can see how tight this range is, and we get our first green close above this high. So I'll just move this here, and we have now a confirmed morning star. So we have a confirmed bearish engulfing on the upside. We have a confirmed morning star on the downside. So what should be the most logical action of price? We should believe that 18,000 level should be a resistance and 17,150 should be a support, which means what would be the trade that you would most likely consider as of now? You would consider, because 18,000 is a resistance, you would consider selling 18,100 put. That is, you would say that the market will trade below, so sell 18100p. That is, you would assume that the market would trade below this level, and your justification would be that there is a confirmed bearish engulfing. And after this this particular candle here, we would now consider doing sell 17,100 C, and our justification would be the confirm bullish, the confirm morning star candlestick. So based on this, we would go for a sell on 17,100 C. So this would be a position that if one were to not consider any tool of timing, they would still perhaps consider. Nonetheless, we move forward. So a nice red close, disturbing one, gap up and a red test of the previous high. Now always remember that these are pivotal highs, and minor breaches, etc., a little bit can happen. So your stops are always a little bit above this. But even if not, let's say you decide not to put it above it, you decided to put it here, that's also perfectly fine. Just that you would have been stopped out. You would have been stopped out a little lower. Some people will get stopped out a little higher, but this essentially is what happens when the market tests the previous resistance stop. People also begin to sell, and also certain stop losses trade off. So both cases are possible. Let's see what happens. But the maximum volatility starts happening once the range is broken. And we know that this high has been since 19th August. We are completely a month has gone by, and we need to see if the month high can be taken out by Nifty or not, and it is. So we get a good gap up. We get a gap up, but it's not very good. It's a very small spinning top. This is called as a spinning top candle. We can see a clear spinning top right above the bearish engulfing, triggering anyone who would have. Okay, so it's the high of this is 18,088. So 18,100 is here. So it hasn't yet triggered, but it would have triggered almost anyone who would have sold. Right now, they are strongly considering exiting these positions. And one maximum 2 days, and they're definitely out. A gap down with a green close, so we can see how the resistance played out. and we can see these partial levels, which are previous gap levels, how that played out. Now here, so I will just remove this bit. Now here we can see there is a foundation, or this is another candle, and this candle is called as a Marubozu. So we, or you can also call it as a bullish belt hold. So now the location is not proper, but this is very difficult to call this as an evening star. It is very tough to call three green candles, even though they're gapping, as evening star. So I will give it a bullish name based on what I'm seeing. If this were a doji, it would have been very easy to call it an evening star. But under real-time practical conditions, maybe I would have definitely said this is a Marubozu, or I would have added something like bullish belt hold. So bullish. The idea is that that you will Google it after we're done. And here, okay, I would, in theory, this is an evening star. I means the only thing that is not fun to see is that all are green candles, but in theory, it is an evening star. That is, an evening star need not necessarily have red candles. But okay. And now we see a gap up and a red close. So we can now see that this has become your dark cloud cover, and this dark cloud cover has happened pretty much on this resistance. So now we can safe, so we understand that where we had initially thought bearish engulfing would be a resistance, we have to move this slightly higher here. So I'll leave this one here, and I'll just create another line. I'll just take this this one right here and change the color to say that to indicate that this is the more relevant resistance for now, because we are now seeing a dark cloud cover. And once we see a dark cloud cover, what we want to see is a confirmation of that, and the confirmation of that would be a red close below the low, and we get a nice red close below the close. So this is a confirmed dark cloud cover, and we have the confirmation that okay, this is a range. We can now safely remove this. The play of bearish engulfing is now out, and what we are now looking at is an evening star dark cloud cover at 18,100. This Marubozu bullish belt hold is clearly gone because the dark cloud cover completely broke it and took it out. However, the morning star 17,100 CE, even 18,100 PE could have been in play, but let's just say that they are out. Now, after this dark cloud cover confirmation, what do we get? It's unbelievable. We get a gap up inside day candle, and so we again see another bullish confirmation, and it is an inside day, or what people call as a bullish harami. But it is not a very small sized candle. That's why I'll not call it a bullish harami. A bullish harami should normally have the length of the spinning top, but okay. And this is an inside day candle, and an inside day candle would also need a confirmation, which would mean a green close above this high. And what do we get the next day? We get a green close above this high, confirming the inside day. Now automatically we can see that what was a morning star at 17,100 has all of a sudden become an inside day at 17,400, which means that this 17,100 CE can now be replaced by a right on 17,000. Oh, I've just mistaken. Sorry, this is a P. I'm so sorry. So this 17,400 P can be now the new support zone. So earlier also when I had mentioned PE here, it was my mistake. So and we can now remove this morning star, because now this is a support like so many other things. For example, this is a support, this is a gap support here, this is a gap support here, there's a gap support here, there's a gap support. So that means I'll just mark it here by taking you can just see this is a full gap, this is a full gap, we are seeing this is a full gap. So in theory every place becomes a support when the market moves up. The question is what support are we considering, and we are looking at the last form support, and we can see that the inside day has formed. So let's see how it proceeds. Okay, so that's the last trade session. So we are most likely looking at Nifty trading between 17,400 and 18,100. This is where we would like to see Nifty trade. Now the question is, now we went through this entire process. We went through it day by day, just to give you an idea of how we use our understanding of trends in the longer time frame, and how we use them with tactical tools like candlesticks on shorter time frames to determine short-term prices, suppose. Now, it is possible that somebody is crying because they would have thought that this was a resistance that was supposed to hold, but the market breached it here. So you can see here, this is the breach of trust, let's say. Okay, and now this is my point. If the market is creating, if the market is temporarily breaking a range high, shouldn't we be expecting it? I means, why should we only look at this high? Then why shouldn't we just look a little earlier ahead? In other words, the market reached this level whether or not we had our trade or no, and that the market could not have cared about hunting down your SL, or in the words of other service providers, even though they are trying to say that they know everything, that is how many orders are placed and how much information they have, the fact that they are being able to use all of that information so productively against you, against your specific position, is extremely unlikely, and it is far-fetched. So not just SL hunting, if you look at it practically. So here I have now put Nifty's chart for almost a full calendar year, maybe more, 2020. So this is a 2-year Nifty chart. Now instead of taking Nifty, let me just give you a stock. Yeah, or maybe something more stable, something like Coal India. Okay. So now this is the Coal India chart. Now we are seeing a lot of volatility on certain days. Now that is okay. So for example, on my cursor is on February 2021, where Coal India opened at 145, approximately 146, and closed at 156. So that's a huge move of almost 6.5% intraday. We can see this move here also. It creates a high of 197 and has a low of 172, almost a 25-point move, which is a 13% move intraday. So Coal India, we can just see, has the potential of swinging 13% intraday at its extreme. For example, this looks like a big candle, but even this would be there about. We can see the high is 185, the low is 171. That's 14 points. That's roughly 9% intraday. So we can see that this is a security that on extremely violent days, 5% intraday is a near given. Like on extremely violent days, you're going to get 5% intradays. And on such a sample set, on such a small sample set, we can see so many volatile days. For example, this one here, the recent one, has a 10-point move, a 5% intraday. This 5% intraday move came as early as 29th of August, so just about 3 weeks back. This is 5%, this is 3%, this is 4%. This is 7%, 4%, 5%. So we can see that 5% is very standard volatility. 12 is extremely high, and I'm talking only about this sample set where I'm looking at this particular. I'm just focused on this candle. Here I can see that okay, 12% on a single day, 10% is quite high, but maybe we have something here in a week or 2 days. 12%, 13% is very high on an intraday. However, 5 to 6% on any standard day of volatility is normal. Now, given that Coal India on a single day of volatility can show 5% move, and on extreme day of volatility can show a 12% move. Now, my question to you is, if we look at this extreme short-term time frame, what will we see? We will see this, like we discussed earlier, a dark cloud cover and a confirmation on the downside. And what are we seeing here? We are seeing a inside day with this candle, a bullish counter. So this is a bullish counter attack. You will see this particular candle. I'll just mark it. I'll mark these candles here. So these candles are bullish counter attack, largely because of the gap down. Now what we are getting is this as a potential range low. Now and obviously this has a potential range high. I mean, this is an immediate, this is an immediate potential range. Now my question is, if you were to buy Coal India now at 229.85, where would you keep your SL so that you are certainly safe? So, which means that which means that would you keep your SL, given that this is the range low, would you keep your SL here? So we know that Coal India has I think, I'm not sure, has a lot size of 4,000 maybe. It has a lot size of 4,000. So if you go, this is 228. If you go here, this is 226. So which means just this distance that we are seeing is roughly 8,000 rupees. If you want to make a position more safe and you go here, it is totally fine. But the only difference now is that this is 32,000 rupees. So what price are you willing to pay in order for Coal India to go and test 230, 240, so from 230? And if it is trending upwards, are you willing to take a bet that this will break this range or not? These are the questions that a trader particularly needs to answer. And in this question, we need to assess where our stop loss will be. Now, you could keep the stop loss anywhere. For example, I could keep the stop loss here, and the only thing I can hope is that, okay, that the next green candle should not go like this. If it goes like this, now is it impossible for the stock to do this? Is it impossible? The answer is no. So therefore the question of SL hunting didn't come. The question is just that for a structure of this kind, you tend to put a stop loss on a low of a candlestick 12 days earlier. That is your method, which got traded. The only question is this method good or not? How will you know it? When you repeat this method hundreds of times and get data around it. But like I said, just by dropping your stop loss from here to here can cost you 10,000 rupees. All of this is expensive, and therefore you are likely to feel good and bad and various other things. And therefore I mentioned that overall financial planning is the key. Ideal would be you put a stop loss here, Coal India just maximum comes till here and then breaks out, and then the next question, then let's say it comes back till here, do you book out or do you wait for a potential next breakout? You see multiple decisions, and here I have marked a clean straight line. You could, instead of a clean straight line, end up getting a rectangle like this. That is, it goes nowhere. So a simple rectangle replaces this clean straight line. So the market reaches this particular high, then comes to this low, and then for the next foreseeable future, Coal India is trading around these levels. I'm sorry, I'm able to drag it. It's trading here. Candle, 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 candle. Not easy. So these decisions are ones that one have to take, and by keeping a tight stop loss in this position, all you are saying is that a rectangular pattern could create another rectangular pattern, and the bigger risk of a rectangular pattern is not the breakdown of the rectangular pattern, but that the stock continues to remain, because Coal India could trade between 230 and 240 for 2 years, and it would be very normal. So even though it's not evident from the 1 year history that we saw on the daily price charts, but if we see longer duration time frames, Coal India doesn't tend to move much. So okay, it doesn't look like that here, but it's largely because of perhaps a zoom. But anyways, and perhaps I'll cover Coal India at a later date. I've just zoomed it and the settings are off. So nonetheless, point being that it is impossible for you as a trader to be able to determine on which of these days did the market conspire against you. It is impossible for you to determine on which of these days was the quarterly result declared. It is not. It is simply not practical, and yeah, for some reason my zoom is off. Nonetheless, so we are done with the presentation. I hope some answers you found satisfactory. I would like to drive home the point that investment in PPF is absolutely required. Having a health insurance is mandatory. Sovereign gold bonds are great investment bets. National pension schemes are good for you if you're a small saver. Axis Bank would be a good company. You could try others too, but Axis Bank would be good. Direct equity only once you maintain these criterias, and futures trading when you have real skill set and you have been trading either equity or some instrument for a few years, once you have done these steps, the decision to quit your job and become a full-time trader and to pursue thereabout will be as natural as it is for a caterpillar to become a butterfly. With that thought, I would wish you the best. I hope you have a good trading week ahead. Take care.